of people are. Some people are like, no, dude, I want to wholesale or flip a deal. I want to make a quick grab at cash. I'm like, I don't want that. I want long-term sustainable performance of my money compounding. So for example, let's say that I'm averaging 34% a year on my money. According to Rule of 72, my money doubles every 2 years. So if I can get my first house and my 100th house and my 3,000th house to all behave with the same ROIs, now I have a money machine. I have a game where you put money in and you're like, oh, I know that if I put $50,000 into a home, and if I'm averaging, let's say 25% ROI for illustrative purposes, and I do that consistently for 20 years, that 50K will turn into $4.3 million.
Welcome to the Real Estate Reserve Podcast. I'm Jason Balin from Hard Money Bankers, and this is Ian Horowitz, my co-host from Equity Warehouse. Thanks so much for tuning in, everybody. If you're a first-time listener, follower, viewer, we certainly appreciate the support. We're going to have a lot of fun today. We got a great guest that we are going to introduce in a second. And if you're a return viewer, follower, audience member, watcher, we certainly appreciate all the support. Couldn't do it without you. We like to bring in great guests that can share a ton of knowledge with you today. So we're definitely going to have a lot of fun.
Yeah, no, I'm excited. I'm glad you just got back. When we're recording this, you just got back from your watching your brother play at the PGA Professional. A couple other friends of ours, one of our business partners, Mikey, was playing there. A couple guys we know made the cut. Excited them to see go play in the tour. But, you know, we talk about real estate here. Guys, if you get any value out of this, please feel free to share it. That's the best compliment you can give us. We go out and find the guys that are actually doing deals, want to talk about deals, and are real people of real estate. So we have a really great guest today. So enough about us, and let's bring in Kris Krohn. You've probably seen him all over the interwebs, and he is here joining us today. What's up, brother?
What's up, man? How we doing? Ian, Jason, good to be here.
Yeah, man, excited to have you on. Actually, I was doing some market research before you jumped on here. I'm going to jump right into it, and I think your most recent video is literally single family versus multifamily. Yeah. I got to straight up ask you, what's your go-to? I know I watched the video. Maybe I'll give the guys a spoiler alert. I thought you had really good points on either way, but why the single family? Why are you so dead set on? I don't want to say dead set, but like you were definitely like,
oh no, I'm dead set.
Yeah.
I mean, I did my first 25 homes as a college kid. It got me a 6-figure residual income. So originally I was bullish. I was like, man, if it had been multifamily, I don't even know if I would have started the game because I was a newbie with no money, with no credit, nothing. And so being able to house hack and basically build a small portfolio of single family, that was easy entry point for me in the game. But later, you know, after I got up to a couple hundred homes, I started asking myself, I was like, am I supposed to graduate to multifamily? Because it seems that that's what everyone's doing. And as I would start looking at multifamily deals and I would look at the ROIs, I'd be like, wait a second. I'm landing often 25, 35, 40% annual ROIs on my single family. And every time I look at these multifamilies, I'm kind of concerned. I'm seeing like 18%, 25% stabilized ROIs. And I'm like, I don't know if it makes sense to quote unquote graduate to a lower ROI. But when I would ask them like, well, why is everyone doing it? They're like, well, it's more doors in one premise. It's easier to manage. And I was like, oh, you're lazy. Like, this is how you scale. Like you do multifamily because I'm like, dude, I don't care if it's hard because I'm a systems guy. And if I build a systems around single family, and now that's, you know, over 6,000 deals ago where I built systems and I learned how to scale single family. And so for me, I actually, to be honest, I took it as a challenge because I was told is like, the riches are in the niches. So be where no one is. I'm like, well, I don't see anyone scaling single. And I was like, it looks hard. It might even be impossible, but let's try it. And so, you know, I look back over my 20 years now in the game and it's like, okay, a couple $1 billion in single family. And I didn't have to sacrifice the ROI for the ease of multifamily.
How many markets are you currently investing in single families in?
Five
markets. And is there more room to scale in those markets, do you think? Or do you think you have to expand into other areas in order to continue this to grow?
Yeah. So there's 324 markets that make up the United States. And I'm only ever investing in the top 5 markets. And the reason why I do that is because half the ROI really does come down to that adage of location, location, location. Most people are like, oh, well, I live in Baton Rouge, so I must look for the right location in Baton Rouge. And I'm like, no, that's not what I'm talking about. I'm talking about macro. economics. I'm talking about the fact that 500,000 people left California last year, 500,000 people left New York, and they went somewhere. Where are they going? Half went to Texas, half went to Florida. So what does that mean? It's like economic winter is what Japan went through in the 1980s. And it basically means we are no longer replacing, like, two people living together aren't making two human babies. And so economic winter is what happens when you don't have a demand for more real estate and you have mass exodus out of cities. Europe's facing that. America's is scheduled to start facing that in the 2030s. And so the only thing that can really save a real estate market from that market force is then migration, not necessarily, birth rates. It's like, okay, so right now, Florida, that is the number one market, by the way, in the entire United States. When you look at population migration, when you look at also migration is not just the retirees, you're also talking about large business coming in. Florida has a surplus of like $20 billion in their budget. They're adding to infrastructure. And so, I look at 10 major macroeconomic components to really say, wait a second, where are we going to create our biggest supply and demand crunches? Because that's where appreciation will be the greatest. And even though appreciation is the only part of an ROI, it is the biggest. And so we lean hard into that.
Go ahead, Ian.
Yeah, no, I was gonna say it makes sense just because, as we're like going through our story, we went from the single family game, grinding it out, got a few hundred houses, and it was the natural progression happened to come up of, hey, here's a multifamily property, pick it up. It's a no-brainer. Hey, pick it up, no-brainer. And I think that's one point that you're trying to bring home here is like, hey, man, it comes down to return on capital. You can find the multifamily deals. That just might be your grand slam. Or you might find a single family and just continue to do singles. Yeah. And we got caught up in some of the commercial real estate craze. Yeah. But I would challenge you, and I know we were talking about markets, is you got market diversification that some of the commercial real estate maybe is a little easier to manage from afar. We're out here in Baltimore. I was a fireman for the city of Baltimore. Yeah. I knew the inner workings. Yeah. And some days you're just like, F it, dude. I got to go. Like the wire is real. So what I would challenge you or want to know a little more is like, the allure of commercial real estate and the scale of the equity pops versus what you're doing in the single family game. How do we compare those two? And with market diversification?
So I'm going to bring up I think some strategy point of views that a lot of people don't have. And I want to talk about actuaries for just a moment. BOLI, bank owned life insurance. What is it? Well, people are getting life insurance and the banks are charging them rates based on when they think they're going to die. They basically are going to say, well, based on your age, based on your health, based on whether you smoke or not, or your family's history on cancers, etc., we think that you're going to live to be 78 years old. And we're going to charge you rates that allow us to arbitrage and make some money so that when you die, if we've bought your policy, hopefully we're going to make some money. So to make it really clear, the bank thinks that Jason's going to die at a certain age. And so he gets a $4 million policy. The bank says, Jason, bro, you're going to leave $4 million to your loved ones. What if we gave you $2 million today? Would you sell me your life insurance policy for $2 million? Jason says, shoot, that's weird. I always thought the $4 million was for my family when I died, but I'm alive and $2 million would be meaningful to me today. So now what the bank's done is they basically bought a part of your life insurance. So this is bank-owned life insurance. And so banks basically know when people are going to die. And based on that, they make money. And that's why that like life insurance companies are some of the most stable banks. That's what I think they are, for some of them for 150 years. And the reason why I got there is because they have actuary data. Well, I applied that to real estate. And one of the things that I hate are pops. I don't want a random deal where I make a monster equity play. I know it sounds kind of crazy. I have different buckets for private equity where I want my pops. What I actually want my real estate to do is behave homogenous. I want my first house and my 5,000th home to literally behave identical. So for example, when I go into Memphis, Tennessee, that's one of my markets that I'm in. And I've got some outskirt markets where I can get TOPs, total out of pockets, down to 50, 60K because I'm buying a brand new house for $180,000, right? And so I'm targeting 5 markets where Florida, it's a little bit higher end, but it's a higher appreciation market. Tennessee is more of a cash flow market, less appreciation, but I also have the ability to basically buy in at a lower rate. And then what I do in that market is I go buy 500 homes. I go buy 1,000 homes. And what I have the ability to do is actually know things like this. as long as my average tenant makes $56,500 a year or more, their chances of default goes down 50%. My repairs are going to drop, from a projected 8% down to 5%. Putting 1,000 homes in that particular market, I can get my property manager to agree to charging me 6 instead of 10% because I'm dealing in volume. All of those little dials, every one of them affects ROI. So what I'm actually after in the real estate game is different than what a lot of people are. Some people are like, no, dude, I want to wholesale or flip a deal. I want to make a quick grab at cash. I'm like, I don't want that. I want long-term sustainable performance of my money compounding. So for example, let's say that I'm averaging 34% a year on my money. According to Rule of 72, my money doubles every 2 years. Right. So if I can get my first house and my 100th house and my 3,000th house to all behave with the same ROIs, now I have a money machine. I have a game where you put money in and you're like, oh, I know that if I put $50,000 into a home, and if I'm averaging, let's say 25% ROI for illustrative purposes, and I do that consistently for 20 years, that 50K will turn into $4.3 million. And now what I'm doing is I'm doing forecasting of future planning for things like retirement. And that's the angle that I play at. So I'm less of maybe your traditional real estate investors. It's like, dude, it's me against the world. I'm building this portfolio. We're looking for pops. I'm making this money. I'm like, actually, I'm turning real estate into a service and an alternative to 401ks.
Yeah. No, I mean, that's interesting. It's, you never hear people talk about it like that. And I mean, I get it. I understand it's hard to do that in the commercial multifamily. They're uniquer situations. You're not going to get the returns out of that. I mean, I kind of look at it as my private lending, sort of my private lending company, where it's more of a cash flow machine and a long-term, a long-term machine, because I just want my capital to be deployed over and over and over and over and over. What are your thoughts on this? So, we're a little sheltered in kind of the East Coast, mostly because there's just not that much land in a lot of the metropolitan areas that we're in, and a lot of the real estate investors are here. And I don't know if there's necessarily proof or data on this, but like I kind of look at it as we're in areas that a lot of these neighborhoods are like resetting. They're built in the 40s, they're built in the 50s, maybe even the 60s, where the whole neighborhood needs to be torn down and rebuilt or completely renovated. And, the current owner's not there. So, for instance, in areas that you might buy 1,000 homes there's probably a lot of inventory. Let's call it to buy, but there's also demand for housing there. Here, there's kind of consistent demand all the time.
Yeah.
Have you kind of dabbled into areas where it's like, hey, there's tons and tons of properties. They just all need to be re-renovated, and kind of speculated on, hey, is this model going to work here? Or is it kind of all based on migration, knowing that, hey, Florida and some of these areas, you're going to get overlap from, I was just in Dallas this past week, and there's so much darn land. Sure. And I was in like the north end of it, and I can't believe how much infrastructure is in place. I was like, is there enough demand that you're just going to build thousands and thousands and thousands of houses? And I think the answer is yes, but it's different than what I'm used to, with all of my assets and investments and growing up, in the DC metro area.
Multifamily is going to struggle for the next few years because whereas we're missing 7.2 million single family homes, we are actually currently overbuilt on multifamily, specifically condos, townhomes, apartments, and things like that. And that's why when you see in the news, you're starting to say, wow, why in this market do we have the real estate in multifamily dropping, but single family? It's like, man, all they would have to do is drop rates 2%. And you're going to see 2020, 2021 real estate values reevaluate all over again. I believe a national median from currently maybe 432,000 over $500,000. And so single family is, I believe, for the next decade, actually a very specific asset class to be very interested in. There is a reason why over $50 billion in institutional funds are being deployed right now into single family. By 2030, they're predicting that another 10% of the single family market is actually going to be corporate owned. And the government is trying to stop it right now because you talk about this renter state where everything is rent to own and everything is rented. We're actually removing one of the most important rights from humans. What originally drew my German immigrant father to this country was the right to own land and property. And that was part of his American dream definition back then. So to kind of get Jason back to your question, after 2008, arguably the best thing that ever happened in markets that houses had been worth 300 or 400 grand, brand new, had dropped to 100, 120, 150. I just started buying them all up because I knew
South Florida, all those places.
Yeah. So I started snatching it up everywhere. But at the same time, I made an epic mistake. I went to Freddie and Fannie and bought a tape of a couple hundred homes in Michigan, in Wisconsin, in Ohio. And so I was owning real estate in Detroit, these neighborhoods that you're talking about that need to be demoed. And this is where I learned some valuable lessons, because I basically bought these homes at a 92% discount from their 2007, 2008 prices. And I thought, there's no way I'm not making millions of this. And I'll tell you, I lost $1 million 2 years later before I got out of everything. And there was so much heartache. And so this was kind of at the beginning of my out of state journey. And so on the one hand, I was crushing it in some markets, like killing it. And in other markets, I was having it handed to me. And I learned some things. I learned about blue states versus red states. And I also learned about the mentality of a blue state versus a red state. I learned that I could go into these older neighborhoods directly in Detroit, for example, and a house that I had bought for 8 or 9 grand, kid you not, that had tax assessment at 100 grand, bought it for 8 or 9 grand, dropped 30 grand into it to get it into full repair, good condition. And I'd rent it out. And this is what would happen almost every time. The renter, the very next month, would default. And then because it was a blue state, it took months to get them out. And when they left, they didn't just take like the fixtures they shouldn't have. They took permanent fixtures. They took copper out. And it was another 30 or 40 grand to get it fixed up, to beg myself to sell it on the market at a loss. And so, kind of a circuitous route to answer your question, 70% of the real estate I buy is brand new. The majority of it are these newer developments. And so do I want to go in and go into these older neighborhoods? Well, you guys know that in the game of single family, that the value of a home is not so much based on perception. It's locked. It's not like commercial. It's not like multi. It's basically the square footage, and the comps have already defined it. And so if I did a special lease option program and raise my rents $300, that actually wouldn't increase the value of the home. If I drop a $50,000 gold toilet in the master bedroom, it doesn't increase the value of the home $50,000 and so very, very similarly, if I buy a home in 1940 from the 1940s and fix it up versus a brand new build in a hot new area, my price per square foot isn't going to be very different from each other, but my newer home, actuary-wise, is going to behave significantly better. It's more desirable. It's path of progress. It's where people want to be, et cetera, et cetera. And so, no, I have like zero interest. If I could go into a neighborhood and doze it because I got crazy prices and rebuild it, that still wouldn't be my game, but that would, because it's violating a different strategy.
Yeah.
For me, that's too much work. Like, why would I do a deal that takes that level of effort when I can buy brand new and actually pull off a higher ROI without rehab? Which, by the way, also means that I don't do deals that need rehab, because for every deal I find that needs rehab, I find the same high ROI on a deal that doesn't. I'm lazy.
Yeah, no, I think that's really smart. And, that's one of the traumas we had here in Baltimore, operating all the single family. It's a very blue state. It's a very, hey, welcome to COVID. You're not getting paid, and we're not releasing any of the funds to get paid. And now fight us for the next year to get rid of deadbeat tenants. And that actually forced our hand to go get market diversification, with the exception of we decided to go into self-storage and take that route, whereas you took the trading up into better asset classes. And that's what Jason and I talk a lot about on this podcast, about always looking at your portfolio, trading up. We're actively selling a piece of our storage portfolio to trade up to better assets.
Yes.
How do you do that in a portfolio of presumably, let's just call it mostly Class B, Class A, brand new build stuff? Mm-hmm. Are you trimming the fat out of your portfolio on a yearly basis, or you just say, I bought these, let's let it ride, and I'll deal with it as it comes up?
No, good question. So my strategy is I buy single family. I buy them below the median because I want it to be the fastest moving real estate, the most affordable real estate, which means my average purchase price is around $260,000. The national median $430,000. I usually, as a rule of thumb, try to stay 30% below the national median. Now, I've been criticized by some people like, Krohn, I can put $1 million into one project, and you have to do 4 or 5 projects to kind of keep up with me. But for me, there is diversification inside of that because my homes perform better when they're below the median. So it's part of the strategy. So I buy them below the median, and then I buy them in the very best markets. And then to answer your question, the other part of my strategy is I hold on to them for 3 to 7 years. And the reason why is because if you calculate the long-term holdings on a single family home, you start picking up diminished returns starting in the 7th year. Yeah. And so every 5 or 7 years. So when I go and identify a market where we have a big problem on supply demand, we have a huge demand, we have little supply, I know that I'm going to be facing extraordinary, like in Florida last year, 44% appreciation. Just think about that for a minute, right? Like strategically finding the markets, it would be like dropping into LA 1980. And the forecast is coming out and all the news reports, everyone's freaking out like, oh my gosh, homes are $100,000. There has to be a crash. I'm like, yeah, fast forward to today, that same house is now over $1 million, right? Like the market isn't coming down. That doesn't mean there won't be crashes. Supply and demand, of course, there will be crashes. It's easy to forecast. It's not like the stock market. This stuff is not rocket science. So what I do is I identify a market that experiences really great appreciation, and then I wait for the exit point. And that exit point is either when I've had enough appreciation to pull my money out and trade a home for 2 or 3 more, or it's when we are starting to correct the supply demand issue in that specific submarket. And then before that happens, I race out. So for example, like, let's just say that America was as simple as we're missing 7.2 million homes nationwide and all markets behave the same, which is not true. And then I say, great, when our $7.2 million demand is dropped below $500,000, you're going to see Krohn do something. He's going to sell everything. Why? Because there's a lag between the communication of our builders and the demand. And what will happen is that 500,000 will whittle down to 100,000, and then it'll whittle down to a negative 100,000. And then before you know it, we have hundreds of thousands of homes nationwide that we don't need. And because the value of a home is what someone's willing to pay, what must the market do? It has to crash. Because if there's no buyer, no one willing to pay, it has to crash. So that dynamic happens in these tiny little submarkets. And I track that data, and that tells me how long to stay and when to go.
Yeah, it's a good point. And I think so many quote unquote real estate investors that are buying rental properties only think, I'm never selling this thing. It's long-term. And I'm guessing your 7 years is typically every 7 years, you probably got to re-renovate, or you have major capital improvement costs, you know, which obviously that's where the diminishing returns come from. So that makes a ton of sense to me. Let's switch gears a little bit. And I'm curious your thoughts on educating the youth and people that are interested in being entrepreneurs. A lot of our viewers are entrepreneurs, or real estate investors and things like that. And, you know, they want to help their kids either take over the business, get into the business. Yeah. Where do we get started? And this is a flaw that I have as well. I mean, I own a pretty, sizable lending company, and, my kids are interested in the space as well. And, sometimes it's challenging to communicate with them, not only how it all works, but like, is there a place for them? Are they ready? When are they ready?
Yeah. I think for me, I'm less interested in trying to pass on wealth to the next generation through, hey, dad owned this business, now you can own this business. I'm not against that. I'm just a way bigger proponent that children need to select their own destiny. So what I do is I view myself more as instead of I'm preparing you for taking over the family business, I'm actually preparing them for how to create their own destiny financially. So that means that we do some weird things in my house. My children are all privately educated. That doesn't mean I send them to private school. It means I pull them out of the public school system, and I've hired teachers that every day come into my home. Like literally, I'm in my at-home podcast studio, and through 2 sets of doors, we have our school, and they happen to be here. Last week they were in DC doing all the whatevers, and then before that we were in Japan, and then we were in the Galapagos, and we do a lot of family travel. And I pulled them out because I first and foremost believe that there's a problem with our education system, and a lot of what they're being educated on is babysitting, waste of time stuff. They're never going to learn. You don't need chemistry, you don't need trigonometry, you don't need calculus. There's just a whole bunch of things that don't matter. Their brains do need exposure to being challenged and to having, some broad understanding of some of these things, but I do it very, very different. With my children, I focus on educating them by their passions and their own personal interests, because I want them to learn to love education for the rest of their life. Like K-12 is not education. That's basically just saying you made it out of diapers. Now, where do you want to educate yourself and go? Like the things that you guys have learned in your lending business, you didn't learn that in high school. You didn't learn it in college, and it wasn't a degree. You learned it in the real world. So in preparation for putting my children in the real world, every Tuesday morning, I spend time with them, push my teachers out of the way, and dad is financial mentor. And so, for example, I was teaching cash flow quadrant on Tuesday, where where you graduate from being an employee to self-employed, and then over to being a business owner and an investor. The week before, we were talking about arbitrage, positive arbitrage, negative arbitrage. The week before, we're talking about how you build real estate portfolios. My son keeps bees. He has a passive business. He produces, he puts $600 out for a beehive. He's 13, by the way, and he produces $1,200 a year in honey. So now he's multiplying his beehives. Now he's working on getting a loan from dad for buying a whole slew of beehives. He's learning about a relatively passive business. By the time he's got a business plan that by the time he's 18, he can have enough beehives to make 50 grand a year, working probably 5 to 10 hours a week. And when it comes college time, it's like, Dad, should I go to college? I don't know. Like, what do you want to be when you grow up, and will that be useful? Because the majority of college isn't. By the way, educating yourself for the rest of your life, that is important, right? So for me, I'm financially teaching my children about real estate, about business, about how my children also, I do something a little different. We don't believe in, socialism. So I don't pay my children for being humans. They don't get an allowance. Instead, I say, you're part of the family. So you have chores that you get to do because you're part of the family. And then I'm going to pay you. I've got gigs out my ears, mow the lawn, do this thing, ship out dad's books, read this book, do these things, and I'll pay you. My children can earn up to $500 to $1,000 a month. Most kids can't do that. And in that home economy, the reason why I do that is because I tell them, dad is paying for nothing, not even your clothes. Like me being a parent does not entitle you to any of my money. But what I will do is give you all the opportunities to make money and then go buy your own stuff. You want to go to your friend's birthday party? Cool. Buy them a present. I'm not doing it. How else are they going to learn to value money if it's just free? How can they value something that is just given? That's why we have this super entitled generation. So I'm teaching my children the principles. I'm letting them build their own game plans in life. And should they express interest in doing anything with me business-wise, I'm very open to that, but I'm not imposing it either.
Dude, that's some legit powerful stuff. I did hear the rent control part. You heard that one, Jason? You said he capped it at $500 a month. I did hear that part, but no, that's sick. Like being able to empower your children. My oldest is 9. She's just getting there to she's starting to sniff around. Like, hey, what is money? And teaching them and making them struggle in the right way. And you kind of covered it, but it's a question that I always have to super successful people is. I'm not really sure where you came from, but I came from a rough background. Now we have success. How do you make sure your kids succeed?
Yeah.
But not give them the struggle in the same sense. And I think you're doing it the right way. I think that's really, really smart, man.
Well, there's a ton of people out there that are in the game of becoming, they want to raise their financial status. And when I ask them why, they're like, so that my kids don't have to struggle the way I did. And I just sit there and I just think, here's a better idea. By the time you die, make sure you leave them nothing. Teach them, however, everything so that they can learn how to become their own self-made person. And maybe it's not nothing, but I'm definitely not writing 7-figure checks to my kids.
Yeah, that's real smart. And same thing. Let them buy into the business long term.
Yeah.
Yeah, dude, it's just powerful stuff. It's literally almost speechless because it's a topic that's top of our mind a lot of the time. So, yeah, man. And what for them, do you see them getting into the business, or do you think that they're going to journey, or you're not really sure right now?
I was very inspired. Tyler Bennett, my acquisitions director, he's helped me transact $2 billion worth of real estate over the last 20 years. And he had his first kid just turned 18 years old, like me. And he gave his child a property in a weird way. He said, I'm going to give you this property and you have to manage it. And I'm going to give you 10% of equity in it. And every single year that you manage this responsibility by hitting all these key performance indicators, I'm going to give you 10 more %. 10 years from now, you get 100% of the house. And by the way, we're going to help manage it and turn it into a bigger portfolio. And I can show you by the time you're 55 years old how to have a multi-million-dollar net worth. And I looked at that and I thought, okay, like there's straddling a balance there that says, I'm definitely giving you a leg up that a poor person couldn't give their kid. But on the same time, I'm going to go long with you and I'm going to make you earn it. And it inspired me. So what I would say is that any of my children that want to express any interest in business, I'm going to be the first one to support them, show them the ropes or help them, but not do it for them. And that's because I think you guys probably learned this lesson in life, that when you give someone something that they didn't earn, that's going to hurt you, not them.
Yep.
No doubt.
Yeah, 100%, man. And I think, dude, you just you crushed it there. And I think it's a good way to transition out, man. It's so powerful. And I think if we leave our audience with that, they'll be able to sit there and think about that for a hot second. Kris, where's actually one thing we like to ask all our guests, like what's one book or podcast that you enjoy that you think everyone should read or listen to? And it could be one of your own, it could be anything.
I've written several books. I've got some of them as gifts for anyone that wants to listen. If you go to freewealthgift.com, I've got free books, free event tickets, free stuff that's knowledge meant to really empower. And so freewealthgift.com is a place where you can go to educate more. I get my kids started on something very basic, Robert Kiyosaki's Rich Dad, Poor Dad. I think that it is a really great entry-level idea of what society teaches versus what a wealthy person would teach. I think it's good financial principles. It's a classic, so I'd recommend that.
Yeah, you can't go wrong with the classic. And finally, where is the best place to find you on the internet? Which I know it's relatively easy, but if anybody is living under a rock, where is the best?
I think the hardest part is just spelling my name the right way. It's Kris, K-R-I-S, Krohn, K-R-O-H-N. And I would just say whatever platform you like to stream, wherever you like to be, that you'll find me.
Yeah, hell yeah. Well, we appreciate you coming on, brother, and we will catch you guys on the next one.
Thanks.
Thanks for tuning in to the Real Estate Reserve Podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.